When you see a huge acquisition in the news, that headline price tag, it's really just the beginning of the story. The real question, the one we're going to dig into, is what is an acquirer truly buying? So today, let's treat the acquisition method not as some boring accounting exercise, but as what it really is, a powerful valuation framework. Think of it like an economic X-ray that lets us see the real assets being purchased and, crucially, sets a brand new baseline for how we measure all future performance.
So let's ground this with a classic scenario, one you'll see all the time. A company pays $1 billion for a target that on its own balance sheet only shows about $300 million in net assets. That leaves a $700 million gap. So what's going on here? Is this just a massive, crazy overpayment? Or is that $700 million paying for something very real that just isn't captured on the books? This is the absolute central question in any deal analysis, and the acquisition method is the framework we're going to use to get to the answer. To figure out that $700 million gap, we have to literally deconstruct the purchase price. We're going to use the acquisition method to unpack that full $1 billion, and in the process, we'll uncover all the economic value that traditional historical financial statements just don't show you. Now, the economic logic behind this whole thing is incredibly precise and, frankly, very powerful. It forces us to do three things. First, we have to identify every single thing we bought, every asset, every liability we took on. Second, we have to measure each one at its current fair market value, completely throwing out its old historical cost. And third, everything gets locked in on one specific day, the acquisition date. You see, this absolute focus on fair value is what flips the script from backward-looking accounting to a forward-looking valuation. So this whole thing breaks down into a really clear three-step framework. First, we do a full inventory count. Then, we slap a current valuation on every single item from that inventory. And finally, whatever's left of the purchase price after we've accounted for all the identifiable net assets, well, that gets categorized as goodwill. And we are definitely going to talk about what goodwill really represents in just a minute. All right, so the first major piece of this analysis is what we call purchase price allocation, or PPA. This is where the magic really happens. This is where we uncover the target's true asset value by doing what's called a fair value step-up, basically revaluing all their assets from what they paid for them ages ago to what they're actually worth in the market today.
Think about a really powerful brand name. A company could spend decades and millions of dollars building it, but if they developed it themselves, you know what its value is on their balance sheet? Zero. A big, fat nothing. But the acquirer, they are absolutely paying for that brand's market power. The PPA process forces this value out into the open, recognizing its true economic worth. Let's say $200 million, right there on the new balance sheet.
And this step up in value isn't just for brands. It applies to a whole treasure trove of intangible assets that were basically invisible on the target's books before the deal. We're talking about formally recognizing the real economic value of things like deep customer relationships, proprietary tech, maybe some incredibly favorable supply contracts. PPA makes these real, identifiable assets visible for the very first time. So after we've gone through and identified all these tangible and intangible assets, and we've given them all a fair value, we might still have a chunk of that original $700 million gap left over. This remainder is what we call goodwill. But I need you to understand, it is absolutely not just some accounting leftover or a plug figure.
Let's be perfectly clear on this. Goodwill is not a passive accounting entry. It is an active, strategic investment. It's the premium an acquirer pays because they believe the combined company, the whole, is going to be worth way more than the sum of its individual parts. Put simply, it is the price you pay for the future.
So what actually makes up this future potential? Well, economically speaking, goodwill is the present value of all the cash flows you expect to get from assets you can't really single out and put a price tag on. This is where synergies live, both cost savings and new revenue opportunities. It's where you find untapped growth options, the strategic value of taking a competitor off the board, and the absolutely immense value of getting an assembled, trained workforce that's ready to go on day one.
And now we get to the most critical takeaway for any of us who analyze companies. All of these fair value adjustments we just talked about, they fundamentally change how the combined company's future performance is going to be measured and, importantly, perceived by the market. This process creates a brand new scorecard for analysts.
Just look at this table. It shows you the direct impact. Before the deal, the target was generating $50 million in profit. Looks great, but after the deal, that new $200 million brand asset has to be amortized, let's say over 10 years. Bam. That creates a new, non-cash expense of $20 million every single year. So reported net income immediately drops to $30 million. And at the same time, the asset base got way bigger, which absolutely crushes the reported return on invested capital, taking it from a healthy 25% all the way down to 8%. The underlying business is exactly the same, but the scorecard has been completely rewritten.
And this is precisely why the sharpest investors don't just take post-deal earnings at face value. No way. They dig deep into the purchase price allocation disclosures buried in the financial statements. They want to understand the size of these step-ups, the new amortization charges, so they can adjust their own models and get to the true underlying cash-generating power of the business they're analyzing.
So, you see, the acquisition method is so much more than just a compliance exercise. It's a valuation framework that reveals the entire economic logic of a deal: what was bought, what it was really worth, and the price they paid for future potential. So the next time you analyze a major acquisition, the question you have to ask yourself is, are you just seeing a price tag, or are you seeing the strategic roadmap it reveals?